Welcome back, everyone. We have some stocks with some super surprising results this week. And we're going to tell you a huge deep dive into whether these are buys, holds, or sells in this video. And we're going to give you all of our rationale, all the reasoning, and what we love most and hate about their business models in their respective industries. Let's get right into the video for our huge fundamental analysis of Zeta and SoFi, right? This week's been unbelievably crazy, right? So you've already had Apple report earnings, you've had Microsoft report earnings, you had Meta report earnings, you had Amazon report earnings. Four of the biggest companies in the whole market reported earnings over a period of 2 days. On top of that, we had Powell's last FOMC as the Fed chair. That the market is in complete just disarray after this week because it just every possible thing happened. We have CapEx shooting through the roof, which is helping our favorite stock and our biggest position that has been running so much, AMD. And it's going to funnel into NVIDIA and everything else in the market whenever these companies are spending money on other companies to build out their infrastructure, get these chips for this big AI cycle for the future years. So let's take you into what do you need to know about Zeta today and what was this earnings, right? So Zeta, 19th straight beat and raise quarter. 19 means they beat their guidance, beat everything, and then you know what they did? They raised their guidance. Who else does that in the market? Nobody. Okay? On top of this, they had their 9 out of the 10 top verticals growing over 20% year over year. And revenue growth came from Marigold, which we're going to get to. What are they projecting with Marigold right now, right? They're not projecting Marigold to really grow anything in the future. So anything Marigold grows is extra on top of this. We're going to get into that. And they grew revenue at a, drumroll, 50% clip. 50. Who else is growing revenue at a 50% clip? No, you know who's doing that? NVIDIA, Palantir. You're in that conversation whenever you're growing revenue at a 50% clip year over year. Unbelievable. And now they're supposed to actually have their GAAP EPS be positive by the end of the year, which, like I said, they're valued on a non-GAAP basis, so that's something you have to think about. But just seeing that GAAP basis is great for Wall Street, and everyone's seeing that. So, like I said, what did they do? They came out and they beat on EPS by 18% compared to what analysts were saying. 18%. They were projecting 0.11. They put up 0.13. Revenue, 7% beat, 50% year-over-year growth. How do you not love that? Okay? And just to show you, how does this business model work? How do they work? Imagine you're a woman, right? 34 years old, woman or man, let's say that. You've been browsing for a new car, right? You've been visiting car dealerships, watching YouTube videos, and it knows from her email, her phone, her address, because that's what Zeta tracks with all their years and years, 15 years worth of data. Then they have an AI brain that analyzes her behavior and says she's 85% likely to buy an SUV in the next 30 days. It knows that she is most responsive to email sent at 7 p.m. and she cares heavy about safety features, and her household is a mid-range vehicle, right? Their execution system takes over from here. This springs into action and it sends her an email at 7 p.m. showing the safety features. Whenever she's on late at night browsing, watching her late night shows on Hulu, we all do that. Zeta knows whenever you do this, right? So then it shows her an ad for it on that show. Later, it sends her a text. And then whenever she visits the website, the first thing she sees, the million things to see on a website, right? It shows her safety content first. It can tell it all to do that. Every single touch point is tracked and personalized. And that's why this company gives people 6 to 7x on every single dollar spent with them. Like I said earlier, they're not even projecting for Marigold to have any huge increase in software revenue. So that's not even baked into any of their guidance for the future. And that's why they just beat so much. And another reason why we love Zeta is, what is this right here? What are they a part of? Software as a service. What's happened to them recently? They've gotten completely sold off that whole sector, right? It's down about 30%, maybe not as much anymore, but 30%. It had huge drawdowns, right? That is the sector you want to be buying. That's the sector that's not running on the market. And even if something happens to the market, that's the sector that can come back to life because all these companies are trading at such low forward price earning multiples because the whole Wall Street's earning that these earnings are going to get wiped out. They just do what they have to do. All them fly like that. So we're going to show you our projections right here, right? We're going to go here and let me move this down. But we're going to use fortgamma.com, right? Free beta out. No card needed. This is going to help you take your investing journey to another level. It's investor-made software by investors who know the whole research process, who know what information you guys need, what you guys aren't looking for. That's going to help you be more efficient with your time to research more companies and spend more time doing what you want to do in life because our site's there to help you become a better investor and be more experienced, right? Have access to institutional grade information, what they're looking at every single day. And our site is going to help you to guide you on your investing journey with every tool you possibly need. So if you're an experienced investor, right, it's a sheer amount of tools and everything that you can do and all the information on it and the ease of life it makes you is perfect, right? If you're a beginner investor, it's guided research function with every tool that we say this is what you should do. That's perfect for you also. So it's the perfect blend of a site to take you to that next level of an investor. And if you are that next level of an investor, it makes your research process so much more efficient and allows you to research so many more companies that you can get way better gains because you find some crazy, crazy deals or whatever in the market. Okay? So here we go. We got right here. Let's go and show you what are our projections on Zeta. And first off, let's just show you the share price. Look at, not even up that much, right? After that crazy beat, right? Barely up. It's up. Finished up. 1.47% today. Wow. Only 1.47% right now. After that type of beat, wouldn't you think it's going to be a huge? That should show you you're getting this value at crazy pricing right now. And you better buy all of it up right now while you can because you're not going to get this chance anymore. And just look at our projections for what we're about to give you them going, right? Let me pull this over a little bit here. So what do we got? Like they're projecting right here, 37% this year. 32% next year revenue growth, 30. They're going to go down over the next 2 years, right? Then income growth, you got to bring it back to GAAP because it's negative. They turn GAAP net non-GAAP profitable. So we have an EPS of 1.01. And they grow net income at 37, 36 over the next few years, right? Keeping those margins, getting better margins, keeping them intact, right? Their P ratio, 40 to 50, just with their growing, like these are pretty fair assumptions, right? A little bit better. And they're only growing at a peg of 1. A lot of SaaS companies at a lot higher peg than 1. With that, you're getting to a 45% share midpoint price, a $61 next year, and a $108 share price by 2029. You know the best part about this? We're using Zeta's numbers that they're guiding for our base case. And what did I just tell you guys? What does Zeta do? They beat and they raise. You would have to go back almost 5 years to find a quarter they didn't beat and raise. That's pretty great that you can get a company doing that. In a sticky business model in the software as a service place, where once they get super scaled with their other customers, they generate more revenue. Right, their ARPU, right? So how much are they generating from users already on the platform? Even if they didn't have another user on last quarter, they still would have grown revenue 21% because they scale up users, and once users get super scaled, they spend more and more with Zeta, and they're more intertwined into the business model, so it's so much harder for them to leave. That's the beauty of these software as a service companies. You're getting a compounded annual growth rate of 56%. Crazy. This is the best thing about the stock. Forget what you just saw in the base case. Forget what you're going to see in the bull case, right? What are you getting for your compound annual growth rate in the bear case if they just stop hitting their guidance and they don't even have, this is them not even hitting guidance. This is them doing worse than they're supposed to, right? anything they're guiding for. And we know that they always raise. Look at this. They're doing worse. 2.3 plus in 27 and over these. They're doing worse, right? Which is crazy. But like 33% this year. Next year goes down to 26. And then look at what our numbers are. You're trading at 4 pegs of less than 1 here also. Was craziest part, right? I mean, you could probably even, this isn't even crazy to bump these up to 25, 30. I mean, that's still probably pretty low. Look what you get if that. You're getting a 26% compounded annual growth rate on your bear case. This is if everything just completely goes horrible in our opinion for this company. A 30% on the high end. The market gets you a 10% compounded annual yearly, 10%. All right, yearly gain. You're getting a 30% with this company. In their bull case, beautiful. 80%, let's just say they grow 40%, and this is them just raising a little bit over the next few years. They're going to a $200 stock by 2029. This is the next Palantir. Calling it right now. You heard it right here first. This stock is so misunderstood by Wall Street, and they're sticky, and once they scale up in customers, they're going to be hard to beat. So just remember this video, remember this, do your research, and don't miss out on the move or anything happening. Okay, so next stock that we want to go through here, other one of our other stocks that we love that reported this week is SoFi, right? Banger quarter, huge quarter. Net revenue up 41%. They grew revenue. Wow. Beat guidance and expectations. EBITDA up 62%, showing those margins are getting better. Member growth on a year-over-year basis, 35%. Product growth, even better, almost 40%, meaning members join and they're not using one, but a lot of them are using 2 different products, right? That's what you want to see because we're going to take their business model as this big flywheel effect that you use one thing, you're going to be like, oh, this is so easy, let me go use another thing. Look at these beats again. This is what you want to see in companies. Always beating on revenue, always beating on EPS. Huge beats and raises, right? They're in the Wall Street's like, oh, SoFi didn't raise this quarter. You know why they didn't? Anthony Noto came on video today and said, we're not putting in any Fed rate cuts in our guidance this year. If there's rate cuts happen, then they beat by even more on EPS. That's what you're thinking. That's what you got to think 2 steps forward, right? That's why they're not in. Even if they don't raise, even with the numbers that we have, just take a look. Wait for what our share price is going to be. So this is their segment, right? So say you go on there to pay off your credit card loan, right? You get a 5% rate instead of paying that 20% rate, right? Then you're like, oh, maybe I'll go get a home loan. Maybe I'll go use SoFi Crypto. Maybe I'll get a SoFi credit card. Maybe I'll use SoFi Invest. It has a platform with everything on there. That's the flywheel effect. If you can do something on every platform, it makes it so much more stickier because then you're going to have to go create 6 new accounts if you use 6 of their products. That's just the huge thing with them. And with the student loans piece, what does that attract more? Home loans even also. Younger people. What's going to happen to younger people over the years, right? They're going to get better jobs. They're going to make more money. And SoFi's going to generate more fees off of that. That's the beauty of the bank. You're taking a lot of risks with the credit cycle. But once you get the people and they stay, they're going to get more richer and you're going to be able to make more money off them. That's what SoFi's betting on. That's why they're that generational bank. Their brand awareness, they're spending a lot, up to 10%. That's great. 1 in 10 people now know SoFi. Their guidance, like we said, is still the same, right? 30% revenue growth, EPS growth of 54%, up to 0.60. The valuation is still incredibly low, and they should be valued at almost a 3-4x compared to their competitors, right? Revenue guidance, Bank of America, JP Morgan, they're growing at 5x revenue of them, right? EPS, they're growing that at 4x, 3 to 4x of these companies. They should be trading way higher. Everyone's like, oh, they should command a bank P ratio of 10 to 20. No, not at all. Whenever you have a company growing like a tech company that is a fintech company, they should be commanding tech valuations. That P ratio, 50 to 60, easy for what they're going to do. We're going to take you through our projections, okay? We have them basically just growing right a little bit above their revenue because what do? They always beat a little bit we've seen in the past. So we're calm with the 31% on our base case, what we think is going to happen. Net income, right? EPS just a little bit better, like we did. And trading at a P ratio, a forward peg of 1, 50 to 60 is pretty fair for a company growing at these numbers, right? Like I said, you're getting a forward peg of 1, so pretty fairly valued. And you're getting a compound annual growth rate, right? Actually more now, which is the crazy part, right? Look at this compound annual growth rate now you're getting on SoFi. Now that they're trading at this valuation, they're trading at a lower share price, okay? You're getting a greater return. Voila, almost 60% compound annual growth rate over the next 4 years from the share price under $17. What's not to love about it, even with them getting diluted? The best part is, look at our bear case. 17%, you're still outperforming the market even if they go to crap. If they go to 25, then go down to 20% and 28 instead of that 30% that they said they're going to do. Lose members, have some credit problem. And they're trading at a forward peg of even less than 1 right now, right? You're still getting a 16%. Even if they traded a forward peg of 1, you're going to get a 20%. That's why we love SoFi and Zeta, because it's all a risk to reward. But you're getting a stock that can trade at these rates. And say they grow revenue at 34%. They blow numbers out of the waters. Everyone's like, holy crap. Their EPS just explodes even more. You're getting a 70% compound annual growth rate. You're getting that stock going to 139. I believe this stock is going to be a $100 stock by the end of 2029, pre-2030. And you don't want to miss it. There's sometimes in the market that you don't want to be that person buying SoFi. Well, it was what? Well, let's go over here. Let's show you. What did it get to, right? It was at 32 for one point, right? You don't want to be that person buying it at 32. Okay? You want to be the person buying it at half of that price with better fundamentals so that it can fly, and you're going to get a nice 36 huge gain this year out of this stock while the market's at all-time highs. That's whenever you want to buy stocks, whenever the sentiment's horrible, but the fundamentals are improving. Go against the crowd. And like I said before, that's what our site's going to help you. Help you do your research. Help you run your projections to say, hey, these are my numbers. This is my stock. You know what? Even if stuff completely goes horrible, they're a bank, I'm still getting a 15 to 20% growth rate on this stock. And I'm happy with that. Well, everyone's like, dude, this stock is completely destroyed. It's horrible. You have to be that one person who goes out and does that. You have to do the research, and you can't rely on other people. If you get into the crowded trades, that's whenever you get caught in this market. Whenever it's a crowded trade, everyone's like, oh, up, 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 up. That's whenever you get killed. Like SoFi at 30, everyone's like, I need to buy this. Going crazy. Cash is coming out of nowhere to buy the stock. And what did it do there? Whenever last year it was at 30, probably overvalued. It's just simple math, and you got to just understand that. I mean, stocks like this are going to be pretty volatile. They're a banking stock, they're a growth stock. Them and Zeta are going to be volatile. If you can't handle that, then they're not for you. If you can't buy whenever they're down a lot, investing's not for you. But if that is for you, that you can hold your hypothesis, be confident in the conclusions you came to, whether you're finding that, and do the research using our site so you can research so many of these stocks, find so many different angles, and understand them on a fundamental level, then this is the game for you. Thank you, everyone, for watching. Please like and subscribe if you like this, and let us know if you want to check out any more of our videos.